Welcome to the Deep Dive.
Great to be diving in.
Our mission today, as always, is to take this stack of sources you've given us, central bank reports, economic analyses, market data, even commentary from some financial heavyweights, and pull out the key insights for you.
And today, we're really plunging into something global, something that's, well, shaking things up.
Yeah, it really seems like it. Exploding yields on government debt, for one. And this potential crisis brewing in Japan. The sources are saying it could be bigger than Greece.
That comparison really jumped out. It's serious stuff.
And we'll also unpack how all this stress, this uncertainty in the traditional system seems to be pushing people towards, well, different kinds of assets.
Yes.
Assets you just can't print.
Right, the scarce ones. A fascinating shift.
Okay, let's get into this source material. Let's see what it tells us about where things stand globally and, what it might actually mean for you.
Sounds good. So, starting with the recent market picture, your sources did mention that V-shaped recovery in stocks, remember that, after the U.S. and China trade news.
Oh yeah, a quick burst of good feeling. But, like you said, the sources show that didn't last long. Pressure quickly started building elsewhere, right? Europe, other places.
Exactly. That initial euphoria faded fast. And beneath it all, the core worry that kept popping up in these analyses, those rising interest rates on government bonds, that's the big one.
It seems to be. And the sources pointed to a specific recent challenge in the U.S. bond market.
Yeah, last week, apparently, the U.S. Treasury actually struggled to sell new government bonds. Just wasn't enough investor demand at the going rates.
Wow. That sounds like a pretty big deal for the U.S. government.
It is, and the sources hinted at what could have happened. The Fed, the U.S. Central Bank, might have had to jump in.
As a lender of last resort, buying the bonds nobody else wanted.
Precisely. Just to stop yields, those interest rates, from spiking even higher. That's the potential consequence when demand dries up.
And connecting this sort of high-level global stuff back down to earth, one source highlighted something really striking. From the Dutch National Bank, the DNB.
Yeah, that was eye-opening. A report through their social consultation payment systems, basically telling Dutch citizens to be ready.
Ready for what?
For card payments to potentially go down for up to 3 days.
A central bank saying, hey, your digital money might stop working? That's unusual.
Highly unusual. And they were specific. Have cash on hand, €70 per adult, €30 per child for those 3 days. They literally called it thinking ahead.
So thinking ahead in that context means having emergency cash, short-term disruption planning.
Right. But the sources kind of set up a contrast there, didn't they? Between that kind of short-term thinking ahead and, well, a different kind.
Like long-term financial thinking ahead, building value, wealth, through other kinds of assets maybe.
Exactly. Which raises a really key question from all this material. With these big global shifts, this bond market stress, what kind of thinking ahead really works? Is it just the emergency cash or, something more fundamental about how you position your finances?
Let's dig into that U.S. picture more. Those cracks the sources mentioned. Moody's downgrade really stands out.
Yeah, that was significant. Moody's, one of the big rating agencies, knocked the U.S. down a peg from APA, the top rating.
Meaning super reliable.
Right, down one notch to AA1.
Okay, maybe just quickly. What exactly does a credit rating agency like Moody's do?
Well, think of them as judges of creditworthiness. They rate countries, companies, financial products, basically grading how likely they are to pay back their debts. AA is the gold standard.
So dropping to AA1, even though it's still high, it's a definite warning signal, suggests maybe a bit more risk.
It's definitely a warning. And the sources laid out Moody's reasons pretty clearly. 5 main points.
Okay, what were they? Rising interest rates making that huge U.S. debt more expensive to carry. That seems obvious.
That's number 1. Then number 2, lower tax income compared to government spending. Just, persistent gap.
Right. And they also mentioned political challenges, making it hard to fix these problems.
Yep. Political polarization was cited, plus the long-term costs of an aging population, Social Security, pensions, that sort of thing.
And the final point.
Persistent high budget deficits. This isn't just one administration. The sources noted it's been across Trump, Biden, Obama. It's a structural issue.
And the market reaction told the story too, didn't it? The 30-year Treasury yield spiked.
Oh, yeah. Hit a level we hadn't seen in 18 years, actually. Since 2007, right before the big financial crisis.
What level did it hit?
It popped above 5% right after the news, then touched, I think the source said 5.18% at its peak. That's a serious jump in the government's long-term borrowing cost.
And even big players took notice. Jamie Dimon, CEO of JP Morgan.
Right. The source quoted him saying he's not a buyer of credit today, called it a bad risk.
Wow. He seemed to think markets were maybe too complacent, ignoring risks like inflation or stagflation.
That was the implication, a pretty blunt assessment from someone in his position.
Okay, now this is where it gets, I think, really interesting conceptually. Ray Dalio's take on these ratings.
Yes, Dalio. His argument, according to the sources, is basically that these standard credit ratings, they kind of miss the real risk with governments, especially governments that print their own money.
How so? They focus too much on just outright default, like not paying at all.
Exactly. Dalio says the bigger, more likely risk isn't that they won't pay you back the dollars they owe you.
It's that the dollars they pay you back with will be worth less.
Precisely. They print money to meet their obligations, that devalues the currency, and boom, you get your money back. But your purchasing power is eroded. Inflation is the silent default, in a way.
That's a really powerful way to frame it, losing value over time, not just losing the principal.
It really reframes the risk. And the sources suggest investors might be catching on, beyond just the official ratings. Things like U.S. credit default swaps.
That's like insurance against default.
Kind of, yeah. The cost of that insurance has been rising. It shows growing concern in the market.
And, the source also mentions some U.S. government action that seems to play right into Dalio's point. A bill passed by the House,
Yeah, projected to add hundreds of billions more to the deficit over the next decade.
which implies more borrowing or more money creation.
Given the trouble selling bonds, the source's analysis leans towards more money creation being likely, which again circles right back to Dalio's warning about being repaid in devalued currency.
Okay, so the U.S. is feeling the heat. But this isn't just a U.S. story. The sources pivot pretty strongly to Japan.
And the language used there is, frankly, alarming. Japan's own prime minister calling it a debt crisis of unprecedented size.
And specifically saying it's larger than the Greek debt crisis.
That comparison really grabs you because we remember the Greek crisis, right? It pulled Europe into turmoil.
Absolutely. That was what, around 2009? Overspending, fudged numbers, investors lost trust, bond yields went crazy.
It skyrocketed. It became a negative spiral, needing a huge bailout.
So for Japan's situation to be framed as larger, what makes it so big?
The sheer scale of the debt. It's 260% of their GDP. That's the highest in the developed world by far.
160%. Wow.
So with a debt pile that massive, even small increases in interest rates mean an absolutely enormous amount of government money has to go just to pay the interest. It crowds everything else out.
And that creates the risk of that same negative feedback loop we saw in Greece. Higher rates, higher costs, less confidence, even higher rates.
That's the potential spiral, yes. And the sources list the underlying issues for Japan, beyond just the headline debt number.
Like the aging population,
Yeah,
driving up healthcare and pension costs.
exactly. And tied to that, low birth rates, fewer workers paying taxes to support more retirees. It's a demographic vice.
Plus decades of stimulus that didn't really ignite strong growth.
Right. Economic stagnation despite all the spending. And now, the final piece. Rising interest rates are making that whole structure wobble.
Looking at their bond yields in the source material, it's quite a change. They were near zero for so long.
For years, 0% in 2016, 2019, 2020, maybe 0.1, 0.5% sometimes. Practically nothing. Now they're climbing. The 30-year yield is getting close to 3%, the 40-year near 3.5%. And the speed of the change is what's striking. Doubled in 2 years, and one source mentioned a jump from 2.8% to 4.5% on some bonds in just the last couple of months.
So why now? That's the big question that the sources tackle. Japan was kind of the poster child for MMT working, wasn't it? Modern monetary theory.
It seemed like it. They ran up huge debts, the central bank bought tons of bonds, inflation stayed low. It looked like proof you could just print your way out of trouble if you had your own currency.
So why did it work for so long, according to the analysis?
A unique mix of things, the sources argue, that structural aging and shrinking population actually dampened demand. Wages were stagnant for decades. Consumers were super cautious. Companies didn't raise prices.
And the money printing stayed mostly in the financial system.
Largely, yeah. On the Bank of Japan's balance sheet, it didn't flood the real economy and push up everyday prices until now. Global factors started hitting home. Supply chain problems made imports expensive. Crucially, the yen weakened a lot, making energy and food, which Japan imports heavily, much costlier.
So inflation suddenly became real for people.
Yes. And now wages are finally starting to rise too, which brings the risk of a wage price spiral. That whole MMT-like balance is being seriously tested.
So Japan's in a bind. What can they actually do policy-wise?
It's tough. The sources say they really can't raise short-term interest rates much because the government's interest payments would explode. It'd make the debt totally unsustainable.
But long-term rates are rising anyway.
They are. And the analysis suggests this isn't because the economy is booming. It's more a sign that investors are getting nervous about Japan's ability to manage this debt long-term. It's a creditworthiness signal.
And this isn't just Japan's problem, is it? It has global ripple effects.
Absolutely. Japan is a massive holder of U.S. Treasury bonds, billions and billions.
So if Japanese institutions, pension funds, banks, whoever need cash or have to adjust because of rising rates at home,
They might start selling those foreign assets, including U.S. Treasuries,
dumping U.S. bonds onto the market.
potentially flooding the market with supply, which would push U.S. yields even higher.
Just when the U.S. was already having trouble selling its own bonds. Wow, it's all connected.
It's a global loop, and it brings us back to Dalio's point about the bond market being the financial system's backbone. If supply and demand get seriously out of whack,
Central banks face that ugly choice. Let rates spike and risk market chaos, or print money to buy the bonds and risk inflation and devaluation.
that seems to be the dilemma highlighted in the sources.
Okay, so all this stress, this lack of confidence maybe in government bonds, it seems to be pushing investors somewhere else.
Exactly. The sources describe a clear trend, a flight to safety, but maybe a new kind of safety, towards assets that governments can't just print more of.
And gold is a prime example discussed.
Definitely. And interestingly, the sources included perspective from the European Central Bank, the ECB, on gold.
What did the ECB say?
Their report basically argued that the huge run-up in gold prices since 2023 isn't just normal market stuff. They see it as reflecting a systemic problem.
Systemic, meaning deep-rooted issues in the financial system itself.
That's the interpretation. They think gold's hitting historic highs because the world is collectively hedging. Buying insurance, essentially.
Hedging against what?
Uncertainty, distrust, geopolitical risk, unpredictable government policies, all of it.
Did they actually say gold is a safe haven?
Yes, the source quotes them saying gold tends to act as a safe haven, especially when geopolitical risks and policy uncertainty are high.
And the data backs this up.
The analysis presented showed gold performing well during stress periods, and it noted two things happening at once: the price rising and central banks themselves buying massive amounts of gold, plus more demand for actual physical delivery like off the COMEX exchange.
So the high gold price isn't just about gold being valuable. It's a measure of how low confidence is in everything else. Bonds, fiat money.
It's like a vote of no confidence in a way, a vote against monetary uncertainty.
And the sources bring Bitcoin into this conversation too, as another scarce asset.
Right, comparing its scarcity model, how new supply decreases over time, to gold, arguably becoming even scarcer algorithmically.
There was some interesting data in the source comparing U.S. ownership.
Yeah, it cited numbers suggesting around 37 million Americans own Bitcoin versus 50 million owning gold. The conclusion drawn in the source was that this implies more individual investors might be in Bitcoin, even if the total dollar amount held in gold is much larger overall.
And putting Bitcoin's market size in context.
It's still relatively small, the sources point out. Stocks maybe $120 trillion globally, bonds $130 trillion, Bitcoin around $1.3 trillion.
So even a small shift of capital from those huge markets could have a big impact on Bitcoin.
That's the implication. Significant room for potential growth if that trend continues.
And who was buying Bitcoin recently, according to the sources? A bit of a surprising pattern.
Yeah, in Q1 2025, the data suggested retail investors were actually net sellers, maybe taking profits during the rally. But institutions, the new ETFs, maybe even some governments, were the buyers.
And despite hitting new all-time highs then, it wasn't like a massive public frenzy.
Apparently not. Things like Google searches for Bitcoin weren't spiking like in past bubbles. Mainstream news coverage wasn't overwhelming. It was a quieter rally in terms of public hype, contrasting with growing institutional moves.
Like the examples given. PayPal offering crypto, Robinhood buying in exchange.
Dubai looking into crypto payments, Ukraine considering Bitcoin for national reserves. These are significant signs of adoption.
And get this, Jim Chanos, the famous short seller.
Right.
The sources highlighted his move.
Right. He's shorting MicroStrategy stock, but using it as a way to effectively get long Bitcoin.
How did that work?
Well, the source explains his logic. MicroStrategy stock often trades at a premium to the value of the Bitcoin it holds. Chanos thinks that premium is too high and will shrink.
So he shorts the stock he thinks is overvalued.
And buys the underlying asset, Bitcoin, which he must be bullish on long term. It's a way to bet on Bitcoin while also betting against that specific stock's premium. Pretty sophisticated.
A smart play. Okay, so what else did the sources say about where Bitcoin might be headed? Any analysis or indicators mentioned?
They looked at a few things. Some analysis compared the current bull market cycle to previous ones using tools like the river indicator.
And what did that suggest?
Historically, based on those patterns, it hinted there might still be room for this cycle to run, maybe into late September. But, strong caveat. Past performance is no guarantee.
Of course. What about the MVRV indicator?
Yeah, MVRV, which compares market value to the average price people paid for their Bitcoin. Based on its historical levels, the sources suggested there could still be upside potential from where we are.
And the correlation with global money supply? M2.
That analysis was interesting. It suggested that if Bitcoin continues to track the growth in global M2 purely based on that correlation, it could imply potential for prices to rise further, maybe towards 150K, according to that specific model.
Wow, lots of potential numbers flying around. The sources also included that story about the analyst who stopped dollar cost averaging.
Right, the person who stopped their regular buys at $100, not because they thought it was the top, but just because that was their predefined plan.
And the point there was, have a plan before things get crazy.
Exactly. Avoid emotional decisions made in the heat of big price swings, up or down. Have your strategy set beforehand.
And they really emphasize the power of sticking to a plan like dollar cost averaging, or DCA, with those examples.
Yeah, those hypotheticals were powerful. Investing 10% of family income monthly since 2018, turning 65K into over 450K.
Or the $50 a week comparison, same money into Bitcoin and gold.
$20 pay invested in each over time. The Bitcoin grew to 114K, the gold to 36K. A huge difference in outcome from the same disciplined saving.
And that personal portfolio example really drove it home, buying regularly, even at different prices, high and low.
Resulted in the total value of the portfolio hitting an all-time high for that investor because they kept accumulating. It showed how DCA can build wealth over time, even with volatility. Profit isn't just about timing the peaks.
Lastly, any technical analysis notes from the sources on Bitcoin's chart?
Just briefly, yeah. Noted the current uptrend, higher lows, higher highs, but also pointed to potential resistance near the recent peak.
And something about volume.
Declining volume on the recent moves up, which can sometimes suggest weakening momentum. It might imply a need for a pause or pullback before potentially continuing higher. Breaking the previous highs cleanly is key, technically speaking.
Needs confirmation, basically.
Needs confirmation, yeah.
Or new catalyst.
Okay, so let's try to wrap this all up. What's the big picture from this deep dive into the source material?
Well, it paints a pretty clear picture of, I'd say, growing stress in the world's government bond markets. See it in the U.S. facing selling challenges, the credit downgrade. And then this potentially huge crisis unfolding in Japan with those global knock-on effects.
Exactly. And all this instability, this maybe growing distrust in traditional debt and the governments behind it seems to be driving a really significant shift
Towards
assets that are fundamentally different, scarce assets, things that can't just be printed away. Gold, Bitcoin, they feature prominently in this analysis. Central banks are buying gold. Institutions are looking at Bitcoin.
It feels like, based on these sources, we might be witnessing the end, or at least the beginning of the end, of that long era of super low interest rates and, frankly, easy money.
And maybe a big revaluation is underway, a shift towards assets valued for their scarcity, their trustworthiness, in a world that feels increasingly uncertain financially.
Which really brings it back to the listener, doesn't it?
Yeah.
The critical question these sources seem to pose for you is,
how might this profound global financial shift, this move away from reliance on traditional debt and towards these scarce, unprintable assets, how might that impact your own financial planning, your own future?
it's definitely something to think about. Thanks for joining us for this deep dive into your source material today.
Hope it gave you some valuable food for thought.